And when you see, sort of, the LBMA attendees at the annual Beano reckon that they all came up with their forecast for 2026, and the average was just under $5,000. So you can see that people are now talking it going higher, but they don't understand why, quite frankly. I mean, it's as you said in the introduction to this, in another article I wrote, how people sort of think, well, it's a bit of unwinding of speculative positions, and you've got a bull market that pauses and so on. But it's not a bull market in gold. This is the whole point. It's actually a bear market in currencies. You've got to look at the other variable, if you like, in any pricing, and that is the currencies. The currencies are going down. I think it's a very difficult question to answer because there are a number of legal hurdles to overcome. I mean, cash is not subject to capital gains tax, if you like. If it was, we'd all be claiming it on the basis
Yeah.
of its loss of purchasing power, if you could establish that. But I mean, this is a difficult one. I cannot actually rule it out, but I think it would be um, a very stupid thing to do, certainly from the point of view of the Treasury. I mean, I can't think of any more effective way of showing your bankruptcy, but by applying taxes on legal tender. I mean, this is something which I think. I mean, we were looking at sort of some pretty arcane law here. So, I don't know whether it would be possible. Might be possible. I don't know. But I mean, they've introduced VAT, for example, on silver coins. So, but that was not a UK thing. That was actually an EU thing. And now after Brexit, we didn't change that. Guess what? And I think also, really from the sort of central banking network, the idea of doing that, I think, actually would ring alarm bells, not just in the UK, but all around the world. It really would. This idea of taxing. I'm probably grasping at straws, and I wouldn't be able to really deny that. But I think it's unlikely, but not impossible. But the
Fair
great
enough.
thing about it, is, how do you collect it? Because a sovereign or a Britannia is bearer money, if you like. It's cash, and you can't establish that anyone's actually owns it. I mean, I could hand my sovereigns over to my children, if you like, and I should declare that, if you like, to the Inland Revenue as a gift or whatever. But if I didn't do it, I think they would have almost no means of checking it out. They really wouldn't be able to check it
Oh,
because
thank
it's
you
not.
for.
We're not talking about ownership evidenced in paper form, in contract form. We're talking about it's if you like, as untraceable as a bundle of pound notes.
Centuries of legal tradition, from Rome's 12 tables to Justinian's codices, distinguish real money from mere promises. True money is final settlement, a payment that ends a transaction with no counterparty risk. Historically, gold and silver played that role. Modern paper currencies and bank deposits, however, are liabilities, claims on an institution rather than value itself. When you pay with dollars or pounds, you're transferring an IOU, not extinguishing a debt. This fragile trust-based structure becomes unstable when governments issue excessive credit. As global debt reaches record highs in 2024-2025, this ancient distinction is resurfacing at the core of today's monetary tensions.
You have to go all the way back to the first Roman law, which was the 12 tables in 448 BC. And for well over 1,000 years after that, jurors were ruling, if you like, on the basis of those laws and producing other laws. And it was particularly in the in the first and second centuries, really, well, second and third centuries perhaps, that three jurors, Alpin, Paulus, and Gaius, really defined the difference between money and credit. Now, money is final settlement. If let us say you pay someone for doing something in gold coin or silver coin, or whatever is regarded as final settlement at the time, then there is no counterparty. It is completely extinguished. If, on the other hand, you pay someone in pound notes, dollars, whatever, pesos, what you're looking at is merely the transfer of a liability, because it's the central bank's liability that you're paying in. So you're transferring that from you to whoever you're paying. And of course, the same is true of deposit accounts at the bank. The bank owes you, if you like. So the bank has the obligation, if you like, to pay you your deposit in gold. Well, we don't do that anymore, but you know what I mean. The basis is still there. So if you pay someone by bankers, by bank transfer or whatever, then you are merely transferring that debt of the bank from you to someone else. It's not final settlement. And that is the difference, really, between a currency and gold. Gold is final settlement in everybody's common law, whereas, a bank deposit or cash notes, or bank reserves, as they call it on the central bank's balance sheet, all that is credit. It's completely credit.
Modern currencies float freely, no longer anchored to tangible settlement assets. Without a gold link, their value depends entirely on public confidence. Confidence threatened by massive government borrowing and aggressive money creation. When credit expansions overheat, currencies erode silently, purchasing power declines, and markets grow increasingly volatile. Analysts today often misinterpret rising gold prices as speculative, failing to recognize the opposite. Fiat currencies are weakening. Central banks themselves are accumulating gold at levels not seen since the 1960s, signaling hedging against their own system. As credit bubbles swell worldwide, currencies are slipping into a slow-motion bear market.
Now, if you tie that credit, the value of that credit, to that final settlement, which is really what you should do, then that credit becomes a gold substitute, if you like, technically, as a circulating medium. But if you don't have that facility, then the value of that credit can fluctuate depending on, really, the faith that people have in it. So this is really what's happening to our currencies now. Because of all the debt that's accumulating, because of the credit bubble, which when it bursts will really impact the stock market very badly and lead to huge, huge rescue operations by central banks and governments in order to stop their economies and their tax base imploding. What they will do basically is they will devalue that credit measured in final settlement, which is gold. It's also silver, but silver hasn't been a standard for a very, very long time. I think it was last a standard in China in 1968 or thereabouts. But silver was, I mean, it was set, the ratio with gold was set by Sir Isaac Newton, about 15 and a half ounces to 1 ounce of gold. And that was a long, long time ago. That was in the 18th century, early 18th century. And so silver, I mean, sterling, the pound was on a sterling standard, really until the time of the Napoleonic Wars, when what emerged out of that was the sovereign base, basically. Though there were sovereigns before that, but the sovereign as we know it today came out. It was first minted, I think, in 1817, 1818. And we went on to a gold standard, I think, in 1821. So the rest of Europe basically followed us a lot later. The rest of the Europe was on, well, certainly Germany and some of the other countries, if you like, to the south and east of it, were on silver standards.
Across centuries, nations experimented with various monetary anchors: bronze in early Rome, silver in medieval Europe, and eventually gold. Britain's move to the gold standard in the early 1800s shaped global finance for generations. Germany's switch after the Franco-Prussian War accelerated silver's decline, permanently altering the gold-silver ratio. By the 20th century, silver's monetary role faded and gold became the final arbiter of value for central banks. These shifts remind us that currencies without settlement anchors inevitably drift. Today's fiat systems, severed from gold in the 1970s, replicate patterns seen repeatedly throughout history and approach similar breaking points.
But after the Franco-Prussian War, Germany managed to get paid reparations by France in gold, and that permitted them to go off the silver standard and onto the gold standard. And it was from that point that the ratio of silver to gold rose, and it just rose and rose and rose. In other words, the value of silver relative to gold fell and fell and fell. So, that's sort of brief history. Gold is obviously, regarded by central banks, who are the note issuers, as the standard now, rather than silver or even copper. I mean, copper was also standard. And if you go back to the early days of Roman law, at 448 BC, the coin was a pound in weight of bronze. It was called the ice. So it's something that has evolved. Gold came in a lot later, but the whole thing was fixed in Justinian's pandects, which were in the 6th century, and then in the 10th century, it was confirmed in the, if you like, the Eastern Empire. Well, it was already the case in the Eastern Empire, but it was confirmed because the Basilica, which was, if you like, the Greek language version of common law going throughout the Orthodox Christian lands, that came in the 10th century. So really, the whole way from all the way across Russia, all the way to Portugal.
Every time a government abandons sound settlement money, the same cycle unfolds: expansion, excess, and eventual loss of control. With global debt surpassing $315 trillion in 2025, the pressure is visible. When today's credit bubble bursts, stocks may tumble, bond yields may spike, and governments will resort to rapid monetary expansion to prevent economic collapse. Such actions risk accelerating the downward spiral of fiat currencies. Gold forecasts for 2026 already hover near $5,000 among institutional analysts, yet few understand the core driver. Currencies are depreciating, not gold rallying. The system is straining toward its breaking point.
Which basically, was originally part of the Roman Empire. I know that Russia extended a lot further than the Romans did to the east, but it really meant that all the nations which went out and colonized the world from Europe took their common law with them. And US, yes, the United States law, basically before they started forming their own law, they referred to Blackstone, and Blackstone was the, if you like, the vademecum, the lawyer's vademecum on common law in England. So it went over with Blackstone and remained the case, unarguably. So that's the history of it. And every time some ruler attempts to detach his currency from gold, always with a view to expanding it without having the responsibility of paying final settlement, its currencies always fail. This will fail for exactly the same reason. And you can see with the debt buildup how close we're getting to it. And when this bubble pops, you can see how they're going to really accelerate the printing press. Is going to make the Reichsbank look like a tea party. It really is. And when you see the LBMA attendees at the annual Beano reckoned that they all came up with their forecast for 2026, and the average was just under $5,000. So you can see that people are now talking it going higher, but they don't understand why, quite frankly. I mean, it's, as you said in the introduction to this, in another article I wrote, how people sort of think, well, it's a bit of unwinding of speculative positions, and you've got um, a bull market that pauses and so on. But it's not a bull market in gold. This is the whole point. It's actually a bear market in currencies. You've got to look at the other variable, if you like, in any pricing, and that is the currencies. The currencies are going down.
In volatile times, traders often chase price swings, unaware they're competing with institutions capable of moving markets at will. True protection lies not in speculation, but in owning final settlement assets. Physical gold and silver offer insulation from credit risk and political intervention, especially during currency devaluations. Temporary price dips should be viewed not as failures, but opportunities for long-term holders. When the credit bubble ultimately ruptures, selling tangible wealth for collapsing currency will prove dangerous. For savers seeking resilience, this is a moment not to gamble, but to safeguard. In uncertainty, real assets, not promises, endure.
Now, nothing happens in a straight line. We'll admit that. But basically, if you want to trade this, then your life is in your own hands. And if you want to trade it, basically you're up against some very big people with very deep pockets. Little old you will get wiped out, I can assure you. So this is not a market for trading. It really is not. I mean, you can go to bed at night and say, oh, I've got a nice little profit. You wake up in the morning and find they bashed it. Why they bashed it? Well, it's got nothing to do with fundamentals or anything like that. It's got to do with book positions.
Mm-hmm.
And if they think they can shake you out, they will do so. So by the same token, I don't get in the business of making price forecasts. All I can do is I can tell you why things are moving, not how far they're going to move at any one, in any time frame. But stackers should be rejoicing. I know what will happen. Most small people, but I don't mean that in terms of stature, but I mean that in terms of funds, will be, they will be disillusioned if they see the gold price fall back to, say, 3,600 or 3,500. Well, the answer is that basically nothing has changed at all. Governments are being horribly irresponsible. Their situation is getting worse. I guess that the moment will come when that credit bubble pops. And when the credit bubble pops, you start seeing equities falling, you start seeing bond yields rising. And at that time, I don't know, I mean, if you're terribly worried, you might sell some of your gold because you're not thinking in terms of final settlement and credit. It's credit where the risk is. If you sell gold, you're buying credit. Do you really want to do that? No, this is, I mean, I think that the right attitude to take is, a setback like this is a gift for stackers, a gift for people who perhaps might have missed the boat a bit. They need to get in and protect themselves. This is a time not to sort of speculate to accumulate, which is the attitude. It's a time to protect what you've got. It's as simple as that.